Make sure to hit that subscribe button and turn on notifications. By subscribing, you'll get access to more videos packed with valuable content on financial intelligence.
Let's look at another case that illustrates the benefits of asset protection. Sammy was an astute real estate investor. He had started out as a carpenter working for a company that built homes and did remodeling jobs. As Sammy learned his craft, he got to know some of the clients. He soon realized that the clients who spent $10,000 with the company to remodel a property were turning around and making $50,000 when they later sold the property. Sammy liked being a carpenter, but he liked making money even more. So he started by buying at a discount a rundown property that he could fix up in his spare time. While he experienced a few setbacks and had some learning pains, Sammy earned a $20,000 profit after the sale. Since then, Sammy has been buying distressed properties, fixing them up, and selling them. In the last 6 years, Sammy has also been fixing up duplexes and fourplexes and keeping them for his own portfolio. To further his real estate options, in the past year, Sammy started building spec houses for sale and for profit. Sammy had assembled a good team of professionals. He had learned from his CPA and attorney that each of his 3 real estate activities, remodeling for quick sales, holding and keeping, and building homes for speculation or spec home sales, required a different legal strategy and a different means of taking title. His strategy was as follows. 1. Remodel for quick sales. This is the strategy Sammy first started with, and it continued to constitute a significant portion of his profits. Still, as more new investors were getting into buying and flipping, the sale prices for distressed real estate were increasing. Sammy knew what his margins were and wouldn't bid on dilapidated yet overpriced properties as others were doing. Nevertheless, there were plenty of good fixer-uppers in his area to acquire. Because Sammy was flipping several properties a year, he was subject to ordinary income taxation. This meant he had to pay a 35% tax, the highest federal income tax rate as of this recording, on all of his flips, instead of only a 15% capital gains tax rate. On these properties, Sammy didn't want to wait a year. He wanted to turn them and cash them out as quickly as possible. If there was a higher tax rate, so be it. There was a second reason Sammy had to pay the higher tax rate, and that was because flipping properties was how he earned his salary. When you earn money through a trade or business, that income is subject to ordinary income rates. When you are flipping 2 or more properties a year, or if all you do is fix up properties, even at the rate of just 1 per year, your income may be subject to income tax withholding at rates from 10 to 35%. This income may also be subject to payroll taxes of 15.3% on the first $94,200 of income and 2.9% Medicare withholding above $94,200, as of this recording in 2006. This brings us to the best way to take title for Sammy's and for your flipping activities. While in a large majority of cases you will want to take title to your real estate in an LLC, for flipping you'll want to consider using a Subchapter S corporation. The reason for this, as with so many other things in life, has to do with taxes. In a business operating LLC, all monies flowing through the entity to the owner can be subject to payroll and Medicare taxes. The same is not true for a passive holding LLC. So we must distinguish between an LLC that passively holds real estate and one that conducts a trade or business, including a business operating as a real estate flipping LLC. An LLC that passively holds real estate for investment purposes offers excellent asset protection. As well, all monies flow through the entity, i.e. there's no tax at the entry level as in a C corporation, to the individual. Because the individual, Sammy, you, whoever, usually has another job, payroll taxes do not attach to this stream of income. Likewise, receiving rents from investment real estate is not classified as trade or business income to which payroll taxes apply. The result is different with a business operating LLC. Sammy's business of turning fixer-uppers conducted through an LLC results in all monies flowing through being subject to payroll taxes. As we all know, Social Security withholding does not lead to glory or glorious returns. The system is broken and may never be repaired. So if we can pay our fair share without going overboard, instead of paying every last dollar into the system, we'll be better off in the long run. The principle here is that you can spend your own money more wisely than the government can. It is a timeless and enduring principle to be followed. Instead of having all monies flowing through a business operating LLC be subject to payroll tax, consider using an S corporation. In the S corporation, you will pay yourself a reasonable salary and pay payroll taxes on that salary. But any profits over and above your salary can be flowed through the S corporation as dividends. You'll pay ordinary income taxes on this income, but unlike the business operating LLC, you won't pay payroll taxes on it. Again, payroll taxes, even the 2.9% Medicare tax on salaries above $90,000, can really add up, especially when you consider it may go to a benefit you'll never see. The question, of course, becomes, what is a reasonable salary? Can you have a lucrative S corporation with $1 million in profits and pay only a $10,000 salary and flow through $990,000 in payroll tax-free profits? The answer, of course, is no. Neither of us would work to benefit someone else so greatly for such a pittance in return. Work with your CPA to come up with an acceptable salary level. Comparison information for your industry and region can be found at www.salary.com. By paying yourself a reasonable salary and payroll taxes on that amount, you are then free to flow profits through your S corporation as dividends and avoid payroll taxes on those monies. By using the lower end of the acceptable salary range, you will avoid an IRS audit and not pay more than your fair share of expensive and non-productive payroll taxes. As a result of the foregoing, Sammy conducted his remodel and fixer-up business through an S corporation. Working with his CPA, he paid himself a reasonable salary and flowed his profits through the entity for payment on his individual tax return at ordinary income rates. Strategy 2. Hold and keep. As Sammy analyzed each new property, he would always ask himself whether it was one to flip or to keep. While he knew how to accelerate the return on his money by quickly flipping properties, Sammy also knew that his long-term retirement needs would in part be satisfied by rental real estate income. Sammy's goal was to acquire one new apartment building per year. Typically, his ideal candidate was a duplex or fourplex that needed some repair. In such cases, he could buy below market and perform improvements over time at his convenience. When he didn't have a quick flip to work on, he could keep his crew busy on his hold and keep properties. Sammy always held his hold and keep properties in an LLC, or in California and Texas, where extra taxes were placed on LLCs, he held them in LPs. He valued the asset protection benefits of keeping his properties in separate entities, especially after suffering 2 lawsuits early in his career. The first lawsuit arose when he operated his construction business as a sole proprietor and held his first investment property, a duplex, in his individual name. A client had sued Sammy over some very careless work a subcontractor had performed. The plumber had gone out of business and left the state, leaving Sammy holding the bag. A judgment was rendered whereby Sammy's sole proprietorship was held liable for the significant damages. Since the sole proprietorship offered no asset protection whatsoever, all of Sammy's personal assets were fair game for collection. And because Sammy hadn't used a protective entity to hold title to his duplex, the property was completely exposed to the claims of the judgment creditor. As a result, Sammy lost all of his sole proprietorship assets, his trucks and equipment, as well as the duplex. all lost to satisfy the claims for damages he did not cause. It was a bitter experience Sammy vowed would never happen again. Sammy immediately started operating his construction business for flipping properties through an S corporation. He began acquiring hold properties with a vengeance, putting them all into an LLC. Before long, he had 7 fourplexes and 1 triplex in his one LLC. Then, the second lawsuit was filed. A tenant had fallen at the triplex. Normally, an A-rated insurance company would have covered the claim. But Sammy's insurance company was C-rated and argued that Sammy had intentionally maintained a dangerous condition on the property. They didn't cover the claim. Sammy was furious with the company and the insurance agent who sold him the commission-rich and coverage-poor policy. The dangerous condition was a stair-step that had just broken. It wasn't intentionally maintained that way. Sammy and his attorney considered bringing a bad faith lawsuit against the insurance company for failing to cover the tenant's claim. But that involved a great deal of time and money, and all of Sammy's extra time and money were now being spent defending the tenant's claim. As it turned out, the tenant prevailed against the LLC that owned the triplex. The good news was that Sammy's construction business and personal assets were not exposed to the claim. The bad news was that the judgment allowed the tenant to proceed against all of the LLC's assets. 2 of the fourplexes were owned free and clear. The tenant's attorney was able to attach the fourplexes and sell them to satisfy the claim. It was after this experience that Sammy came to appreciate that one did not want to own too many properties in one LLC or LP. By holding 8 properties in one LLC, a tenant with a claim involving one of the properties can reach the equity in all 8 properties. Sammy decided that in the future, only 1 property would be held in each LLC. Putting too many properties in one LLC created an attractive target for the professional litigants of the world. It was well worth the increased annual LLC filing fees for Sammy to segregate his real estate into individual LLCs. It was a form of insurance in case his insurance company failed to protect him as promised. Now that you realize how important it is to hold real estate in an entity, what kind do you choose? The following are descriptions of the types of entities available for holding real estate, as well as their tax advantages or disadvantages. Personally held property. There are no distinct tax advantages or disadvantages to holding property simply in your own name. However, the danger lies in holding property without the protection offered by a limited liability business structure. Partnerships. The flexibility associated with partnership tax law makes it highly favorable for holding real estate. Because distributions from a partnership come out at basis, not at fair market value of S corporation distributions, you can easily move assets in and out without tax consequence. A partnership also provides an ideal structure for doing a Section 1031 like-kind tax-deferred exchange. Because income from partnerships flows through to individual owners, taxes are paid on the individual level. There are 2 types of partnerships. The general partnership is never recommended because they offer absolutely no asset protection. On the other hand, a properly formed limited partnership is a reliable entity for holding real estate. By properly formed, we mean one that has a corporation or LLC as a general partner, thus encapsulating the unlimited liability of a general partner into a limited liability entity. Another reliable entity for holding real estate is the LLC, that is taxed as a partnership. Like the properly formed LP, the LLC taxed as a partnership offers excellent limited liability along with beneficial flow-through taxation. The use of one entity over the other may be decided on the basis of state taxation. As mentioned, California and Texas levy extra state taxes on LLCs and not on LPs. Many people would choose to use an LP in those states to save on taxes. For people in other states, the expense of an extra entity, be it a corporation or LLC, to serve as an LP general partner may tip the scales in favor of an LLC. Be sure to consult with your advisor as to which entity is best for you. S corporations are flow-through entities, meaning that the taxable income earned will flow through to the individual owners and will be taxed at their individual rates. However, property distributions from an S corporation to the individual shareholder owners are done at fair market value, which can mean extra taxes. The benefit of an S corporation is that the earnings are not subject to self-employment tax, as they are in partnership taxation. But for real estate holdings with passive income, which aren't subject to self-employment tax anyway, there would be no extra benefit in holding through an S corporation. This is the reason that an entity with partnership law is recommended for real estate holdings. However, if you flip properties with your real estate business, this could be considered active trade or a business, and your income would be subject to self-employment tax. As discussed in Sammy's case, this would be a good situation in which to use an S corporation. C corporations. The capital gains rate for the corporate level is much higher than the individual rate, so it is not usually a good choice for holding real estate. The only time it might make sense for real estate investing is if the company is publicly traded or if there is foreign ownership of the corporation. If this isn't your situation, consider using a flow-through entity such as a partnership that can provide much lower tax rates if your individual owners of the partnership are, in fact, individuals. Joint ownership for 1031 exchanges. If you plan on holding your real estate with multiple partners and the property may be used for a future like-kind exchange, the property should be held as tenants in common. If you hold the property as tenants in common, you are still able to use a single-member LLC to protect your interest. For example, you and your partner hold title in the property as tenants in common. Your individual LLC and your partner's individual LLC will be named as the individual owners on the title. By using this format, you will be in compliance with the new rules regarding multiple owners and future 1031 exchanges, and you will get the asset protection you need. That said, you can also do a 1031 exchange using an LLC or LP, as long as the new property is held by the existing LLC or LP. Limited liability companies. The LLC or LP is the ideal structure for holding real estate because of the tax considerations involved. These considerations include the capital gains treatment, the tax benefit for flow-through passive losses, and the potential distribution of assets. Let's consider the following tax issues. First, capital gains. The LLC and LP are both flow-through entities, meaning the gains and losses flow through to the individual taxpayer. If the property is sold in the future, the profit from the sale is subject to capital gains. The reason you will want to have individual tax rates apply to this sale is that the capital gains treatment for individuals is much less than that for corporations. Number 2, tax benefits. Flow-through entities such as the LLC or LP may also allow passive losses to flow through. This usually will happen if you have used the previously discussed tax benefits, such as accelerating depreciation and real estate professional status. You will want these tax benefits for yourself. Number 3, distributions. While S corporations can provide the same flow-through of capital gains and tax benefits as LLCs and LPs, they do not provide the same flexibility regarding distributions. For example, you own a large piece of property that later gets divided into 2 parcels of land. You now own 2 pieces of property and most likely will not want to hold them in the same entity. If you were holding the property in an S corporation and wanted to transfer one piece of property out, the property would have to be distributed at fair market value. This would be a taxable event because the value of the property has most likely appreciated since you bought it. However, If the property were held in an LLC or LP, one parcel of property could move out at whatever value it is held on the books. Therefore, this event would not be taxable. This is the advantage of holding real estate in LLCs or LPs when it comes to distributions. Now that we have selected the right entity, let's focus on selecting the right property. As soon as you make the decision to start investing, you'll be subjected to everyone's opinion about where they think you should invest. You will hear about the hippest, hottest real estate markets of the moment. This year it's Phoenix, Charlotte, and Reno. Next year it will be Teton Valley, Idaho, and Oklahoma City. However, you should not be overly concerned with trends. There will always be real estate deals available in every market. Put your energy into thoroughly analyzing the property, conducting the necessary due diligence, and performing the investigative review. By using the following tips and secrets about these processes, you can make any real estate deal a great opportunity. The most important step to take before you even start running numbers is to come up with a plan. In this plan, you must first clarify the specific purpose your real estate will serve. Are you buying this property in order to develop and resell it? Or are you hoping to capitalize on the cash flow it will generate? Becoming clear on exactly what you want will help you narrow your search. Cash flow investing is a slow process. While you won't get rich quickly, the investment will most certainly pay off eventually. If this is your goal, you must focus specifically on creating cash flow by following these steps. Number 1, specify the type of property you'd like: single-family home or multifamily units. How much money do you have to invest? How much of a loan can you qualify for? Number 2, stake out locations. It is recommended that your first investment be located near you. You will most likely be familiar with trends in your own area, and it will be easier to work with a local real estate agent. You may want to consider looking for properties in working-class neighborhoods. They usually require less money down than high-end properties, meaning more return for your money. Number 3, once you've picked out a few specific neighborhoods, assess the areas. What do you see when you look around? Are the houses well maintained, and is there obvious pride of ownership? Or do you see numerous for sale signs? Use your real estate agent as a resource here. He or she can provide you with the comparative values of the properties over the years. Number 4, identify properties you may be interested in. Ask everyone you know whether they are aware of a property for sale. Don't think that your real estate agent is your only resource. The team you have assembled, including your broker, appraiser, accountant, and attorney, can be great sources of information. Number 5, assess the state of the property. Once you have found a property in which you are interested, you must gather information on the surrounding properties to get an idea of the value. Investigate comparable values, comparable rents, and the relative values of the properties in the neighborhood. Keep in mind that an ideal investment property is generally at the middle or lower end of value for the neighborhood. Investing for appreciation can be a successful strategy, but it can also be a risky one. First-time investors can make big mistakes if they are blinded by dollar signs and don't consider these crucial scenarios. How long would you be able to keep the property if you lost your current job? Since investing for appreciation usually means you will have little, if any, cash flow, how could you afford this property? How many such deals can you afford? What will happen if you can't sell the property as quickly as you had planned? For instance, if it takes you many years to sell the property in order to double your money, your actual return may be less than if you owned a property for cash flow. After considering these warnings, realize that investing for appreciation will only be truly successful if the circumstances are right for both you and the property. First, identify what type of market you are about to enter. A buyer's market has more sellers than buyers. This can be a great situation for buying property. You can get good deals since there are a lot of properties to consider, but not many buyers. The only catch is that if the market continues to decline after you buy, you could have gotten an even better price if you had waited. In a seller's market, there are more people looking to buy than there are properties for sale. In this situation, it may be hard to find a good deal unless you look for properties that need some work. Real estate agents may not even bother with this type of property in a seller's market. They may be more interested in quick and easy sales. Therefore, you may have to deal directly with the seller. Once you identify a prospective property, enlist your real estate broker's help to find valuation trends for that area. Since the best indicator of future appreciation will be the past recessionary cycles, look to identify patterns in the appreciation. Does the property appear to be increasing in value with every cycle? If there seems to be an identifiable cycle, are you able to determine where the property is in the current cycle? If the property and local appreciation fit your profile, then review the cash flow again. Consider how long you could hold the property if your funds dried up, as well as how long it would take to sell it if you needed to do so. In certain cases, the appreciation may be strong enough to overcome these concerns. The investigative process performed on a property in which you are interested in buying is called legal due diligence. Properties can have any number of problems or claims associated with them, from structural or electrical problems to environmental and hazardous waste issues. These are things you need to be aware of before you buy. If you are wondering how it is possible to perform a lengthy investigation without slowing the buying process, the answer is you must write an offer in which the due diligence is included as a contingency for purchase. This way, if your investigation turns up something you don't like, you'll be able to back out of the deal, no questions asked, with all deposits refunded. These clauses in offers usually read like this: this offer is contingent upon buyer's inspection of the property and acceptance of its condition within 30 days from acceptance. Your offer can include flexibility, which means you can have several contingencies that may allow you to back out. These contingencies may include financing contingencies. A condition of your offer should be that you successfully obtain suitable financing and show proof of loan commitment within a certain time frame. Appraisal. The property should have to appraise for at least what you have agreed to pay for it. If it does not, the buyer can void the contract, or the seller may agree to reduce the price. Professional inspection. You will want to have the property inspected. A general inspection contingency can cover a variety of concerns. For example, certain properties should have environmental tests, such as land that once housed a gas station. You may also want a home tested for radon, lead paint, toxic mold, termites, the water tested for purity, structural soundness, electrical, mechanical, and plumbing inspections, etc. However, the contingency language will have a time frame in which these inspections must take place, so you will want to promptly locate the proper inspectors immediately. It is important to understand that a general home inspection service will not cover many of the types of inspections you want conducted on the property. Home inspection services are not conducted by structural engineers or persons with any level of expertise in plumbing, electrical, or similar specialties. Nor do many check for building code violations such as snow loading, earthquake protection, or hidden defects. Inspection by a qualified, licensed structural engineer is advisable, as is using a plumber or electrician or other specialists for specific areas of concern. Personal inspection. A personal inspection contingency will give you an easy out should you want to back out before its expiration. It should be worded subjectively, allowing you to get out of the contract simply because you decided you did not like the property after all. General due diligence. A general due diligence paragraph is also a very good idea, especially if you plan on adding a guest house or developing the property in any way. You will want the offer to contain a due diligence period so that you can obtain approval for your plans from the proper authorities. Survey. It is also a good idea to have the land surveyed or the corners marked. Your approval of the corners can be a condition for the sale. Review of the plat, covenants, conditions, and restrictions. Plats often have notes that contain restrictions not found in the covenants or deed. It is important that the plat and any other restrictions on the property be reviewed by an attorney and that any restriction be approved by the buyer. 1031 language. If you are purchasing the property through a 1031 exchange, it is important that your contract mention this as well as provide that the closing must occur within the bounds dictated by the exchange and that the seller will cooperate with these needs. Review of title commitment. You will want your title commitment reviewed by an attorney, as the commitment will tell you if the seller has marketable title as well as list items of record that affect the subject property. Approval of any leases associated with the property. If you are purchasing rental property where any leases or tenancies are in place, you will want the offer to be contingent upon your review of those agreements. Water rights and mineral rights. If water rights or mineral rights are a concern, be sure to make the review of those rights a condition of the offer. Contingent on another closing. If you need to sell your present property prior to closing on the property that you are offering on, it is important to make closing your own sale a condition of your offer. Otherwise, you may find yourself making 2 mortgage payments instead of just 1. At the end of your inspection period, many good brokers will prepare a written statement for you to sign in which you accept the condition of the property, thereby removing the contingency on the offer. If you do not want to accept the property after your investigation, you don't sign the agreement. In all cases, whether you want to buy or call the deal off, it is best to clearly communicate your intentions in writing to both the seller and the broker before the deadline, so that no party involved makes an incorrect assumption. Chances are any property you're considering purchasing has minor superficial issues you'd like to correct eventually. Property inspections should not focus on these little imperfections, since every property has its fair share. Your pre-purchase inspection should be aimed at uncovering problems that aren't so minor, meaning issues with the foundation, roof, or heating, plumbing, and electrical systems. If problems are found in any of these components, you will want them addressed and resolved before you take possession of the property. You can request that these repairs be completed before closing by drafting a repair addendum, a summary of required repairs acknowledged by the buyer, realtor, and seller. Not only will this ensure that you don't have to face these expenses immediately after your purchase, it reduces the risk that lawsuits will be filed disputing the condition of the property. Any major problems found during the inspection will be summarized in the inspector's report. A detailed description of the problems will need to be transcribed into the repair addendum, thus communicating the findings to the seller. Always include a copy of the inspector's report so the seller can reference it. Then list, in the order you would like them completed, the repairs you would like the seller to address before reinspection. Use language that communicates your expectations clearly. If you want a component completely replaced, be sure to use the word replace rather than repair. Make a request that once the work has been completed, you will receive copies of receipts. After work has been completed, another inspection of each of the items included in the repair addendum is required. This should be done well in advance of the final walkthrough and closing, just in case additional work is still required. If this is the case, another inspection report and repair addendum signed by the buyer must be presented to the seller. The title report holds all the specific information about a particular piece of property, the physical details, the type of ownership, and exactly what rights are granted to the owner of that property. Sometimes there are flaws in the title that can bring about challenges for the owner. Title insurance can offer protection against such difficulties. Many of the flaws found in titles are very subtle. Because of this, many lenders require title insurance and will not loan money until they receive a clear and insured title report. Most title insurance protects against defects in, or liens or encumbrances on, the title to a piece of property. The insurance company will help in defending against any challenges to your title to the property. However, insurance companies will only agree to insure against certain things. You must be aware of what coverage your company is providing. When you receive the title report, time spent carefully inspecting it will be well worth it. You should consider having your attorney look it over as well. If you close a real estate deal and then realize your insurance does not cover problems that were disclosed in the preliminary report, there is no going back. Once you have checked the title report for accuracy, you must carefully inspect anything the insurance provider has chosen not to insure you against. This is where you will find any restrictions or limitations on the property. These can come in many forms and have different consequences for the buyer. The following are examples of what you might find on your title report. Easements. This is when another person or the public has certain rights to your land. Although easements may not necessarily have a negative effect on your real estate deal, you must first be aware if one exists, and then you must consider what type of impact it will have. Covenants, conditions, and restrictions. These are usually referred to as CC&Rs. They can limit your ability to use or sell the property and are enforceable by the seller or third parties. These can include building limitations, limitations on use for business, and even aesthetic requirements for the building. Be sure you are aware of the consequences of a violation of such a restriction. Sometimes they can result in financial liability or may cause ownership to revert back to a prior owner or third party. Although CC&Rs don't necessarily have an adverse effect on your property and may actually serve to increase property values, it is important to carefully study them. After all, they do affect your ability to use and sell the property. Mortgage or deed of trust. These are the result of loans taken against the property. In some states, an existing mortgage or deed of trust can affect the title directly or can create the potential for a lien or foreclosure and sale of the property. You must determine if this will affect the nature of the property you may purchase. Notice of default. This indicates there is an existing foreclosure proceeding against the property. If this is the case, you should not independently purchase the property. Instead, you may want to purchase it as part of the foreclosure proceeding. Always consult with your attorney before buying a foreclosure. Parties in possession. This exception means that any rights or claims of parties that currently possess the property and are not recorded in the public records will not be covered by the insurance policy. To protect yourself from this, especially from the rights of someone who is wrongfully in possession of the property, have the property surveyed. This can determine whether any part of the property is currently in the possession of a third party. Survey exception. This can include any rights or claims of parties in possession, easements or claims of easements not shown by public records, boundary line disputes, overlaps or encroachments, and any matters not of record that could be exposed by a survey and inspection. Simply by having the land surveyed and inspected, you can protect yourself against such an exception. Mechanics liens. These can be tricky because they may not appear on the record even if they exist. Mechanics liens take effect when construction or improvement work starts, but aren't recorded until the work is finished but not paid for by the owner. This type of exception means that the insurance will not cover any lien or right to a lien for services, labor, or materials for any prior or subsequent development. However, some insurance companies may provide coverage if the seller guarantees against mechanic liens and if both buyer and seller have proper documentation in place. State or federal tax liens, judgments, bankruptcy. Any taxes, assessments, and judicial proceedings not shown as existing liens in public records will not be covered by the title insurance. It is a good idea to get a warranty from the seller that no such proceedings exist. Notice of default is important. In bankruptcy proceedings, a title insurance company will usually hold insurance until a court order is filed that removes the property from the bankruptcy court's jurisdiction. Analyzing and understanding the title report early in the due diligence process can save a great deal of time and energy later in the acquisition process. Now let's consider a case where due diligence wasn't performed. Allison had always wanted to own her own restaurant. She was finally in a position financially that allowed her to start realizing her dream. She began looking for a unique space to house her gourmet restaurant and wine bar. Because she believed that a new building wouldn't have the character she desired, she started looking in an older section of town. It was there that she fell in love with a charming brick building located right on the edge of the river. From the moment she saw the place, she knew its old charm would provide the perfect backdrop for her restaurant. To her surprise, the price was lower than she had imagined. The seller, Antonio, was motivated to sell because of a divorce. Antonio was in such a hurry to sell that he offered Allison a discounted price if she would have her inspection performed within 15 days. Allison didn't want to lose the building or the great price. She agreed to Antonio's stipulation and made her offer. A quick inspection was performed, and Allison was satisfied that no structural problems were found in the building. Although the inspection process was not as thorough as she would have hoped, Allison felt she could take care of any problems that might arise with the extra money that she would be saving. A few months later, as she was painting the bathroom for her restaurant's upcoming opening, she noticed a strange smell. She decided it was probably just because the building was so old, but she made arrangements to have someone come in to check out the pipes. What they found was worse than Allison could ever have imagined. The sewage tank was as old as the building itself. It had never been replaced or updated, and now it was leaking. Sewage was seeping into the ground below the restaurant and out into the river. Worse yet, the previous tenant was a dry cleaning business. Instead of properly disposing of their hazardous solvents, they had simply poured them down the drain into the sewage tank. The rotting sewage tank had been breached and was now leaking into the river. Dozens of children who had spent the summer months swimming downstream from the restaurant became ill. When doctors discovered the pattern, the city began testing the water in the river. Sure enough, they found sewage in the water and traced it back to Allison's building and its disintegrating tank. Even though Allison had been unaware of the damage, the town's residents were outraged. Allison paid to have the tank replaced, but then she faced lawsuits that the insurance company would not cover. She was forced to sell the building with its new sewage tank just to pay the settlements. By the time the nightmare was over, she had lost so much that she was never able to realize her dream of owning a restaurant. Allison was held liable because she was the responsible party. The fact that there was hazardous waste on her property was all that had to be proved. There is strict liability in such cases, meaning that guilt or innocence is not the issue, but rather ownership. If waste is found on property you own, you are liable. Federal law recognizes 4 classes of parties responsible for cleanup of hazardous waste. 1. The current owner and operator of the property. 2. The owner and operator of the property at the time the waste was deposited. 3. Those who generated the waste and sent it to the site. And 4. Those who transported the waste to the site. In our example, Allison is a liable party because she is the current owner. She could sue the dry cleaner, but he had died suddenly with no money to his name. So what could Allison have done differently to protect herself? She should have had state-licensed engineers perform a Phase 1 environmental report, a survey of the potential environmental problems on the property. In a Phase 1 report, the engineers will either find no problems and record that in writing, or will find a problem and suggest a more detailed Phase 2 report. If you are unable to get a clean Phase 1 report on a property, it is probably not something you want to get involved with anyway. Banks most likely won't loan money for a property that does not have a clean Phase 1 report. The importance of having a clean Phase 1 report is that it can protect you if a problem should ever arise in the future. You have a good argument that because you had an engineer inspect the property and the property was found to be clean at that time, you had no notice of any problems. If Allison had had her property inspected by engineers, either they would have found the problem and she could have backed out of the deal, or she would have had a clean Phase 1 report that would have proved she was unaware of the problem. Keep in mind that you will also be held liable for any environmental hazard caused by your tenants. This means if one of your renters runs a meth lab out of your apartment building, you will be responsible for a toxic cleanup. This is just one important reason why you should know exactly who your tenants are and what they are doing in your building. My first foray into real estate investing began by accident. Although I was licensed as a California real estate broker for many years, I personally had never held property for investment purposes. I did own a small starter house in a pleasant Reno neighborhood, but soon after my marriage and the birth of our first child, we decided we would need something bigger. We realized that after all the broker's fees and transfer fees, we were going to lose money if we sold the house. So we decided to rent the place out. Our first tenant was the type that always had a creative excuse for why he was late with his rent payments. This came as a shock because whenever I had rented places, I never turned in a late payment. My parents had instilled in me the value of timeliness, and here I was, landlord to someone who could not care less about being on time. As a lawyer, I had spent years listening to other people's problems and lack of follow-through on contracts. However, this situation was becoming personally annoying because I still had a mortgage to pay. On top of it all, I realized I didn't have enough time to deal with any of it. I felt I would be better off hiring a management company to take care of the details while I spent my time working to earn my own money. I figured it would be worth the fee they charged to get rid of some of the hassle. After interviewing several companies, I chose one with a good reputation around town, as well as a reasonable fee structure. The company charged 10% of the gross rental revenues, but would take care of all the bills, arrange repairs, and line up new and hopefully responsible tenants. When I calculated the value of the time I spent managing the place on my own, I was paying twice the amount the management company charged. Everything became so much simpler. In fact, the only contact I have with the company is a monthly statement. However, for some reason, when it came time to purchase my next property, I had forgotten my lesson about the value of property managers. I figured that with a bigger property, I could manage it myself and hold on to all of the gross rents. So the bookkeeper and I now had the duties of lining up vendors and handling repairs, paying bills and collecting rents, handling the bookkeeping, setting up new leases, and doing everything else involved with managing such a property. Now, instead of just one excuse every month, I receive many, including, "I'm an artist, I don't pay rent." "The bartender took all my money." "The Raiders lost again." "My wife met my girlfriend." Again, for someone who lives with a fairly strict view of timeliness and fulfillment of obligations, these casual, half-baked excuses were maddening. More than once I asked, "Am I a landlord or a life skills counselor?" The last straw, when my lesson was finally learned for good, was when a tenant called my law office and insisted that I be pulled out of a meeting. As I got on the phone, she demanded that I come down to the building right away. When I asked what the problem was, she explained that someone had left laundry in the dryer, and since she didn't know whether the laundry was sanitary, she would not touch it. She wanted me to come down and remove the laundry from the dryer myself. That afternoon, I began interviewing management companies. The previous story was not included to advise that everyone use a property manager. Some people enjoy the one-on-one interaction and maintenance of a rental property and feel a sense of pride about doing it themselves. Certainly, some will save a great deal of money by managing their own real estate. But for others, for whom a management company will actually save money and headaches, there are some guidelines to follow when selecting a company. The following are key elements to consider when selecting a management company. Local reputation and references. Since the company you choose will be handling your money, it is important that they be trustworthy and well-respected around town. Vendor and service contracts. Many management companies have strong relationships with vendors and service providers. This may result in lower costs for maintenance and upkeep than you would be able to find on your own. Market knowledge. You want your management company to know what the local market will bear in terms of rents. With the field narrowed by using the recommendations above, now you can do more in-depth investigation into the company's management contracts. Items to consider include compensation for services. Management companies usually charge a percentage of the gross rental receipts, ranging from 5 to 10%. If they receive a percentage, this gives them extra incentive to keep all the units full. Duties and responsibilities. Make sure the contract clearly defines who is responsible for what. What do you, as an owner, want to be involved in? And what do you want to leave to the managers exclusively? The term and termination clauses. You will want the option to give 30 days notice to the company and be able to move on if you are not satisfied with their management of your property. Spending issues. This will define how much the managers can spend without consulting the owner. You will want to approve any large repairs and improvements. Special contract issues. Read the contract for any catches or small print. If a management company asks for a percentage of the brokerage commission if you decide to sell the building, either get the clause removed or use a different company. Reports. As the owner, you will want to receive regular reports detailing income, expenses, and reserves. After contracting with a management company, give them a few months to get settled. Then you will need to craft a system to analyze their performance. You can measure their success by the following: a lower vacancy rate, greater return to the owner, better collections, lower turnover, fewer complaints, a better property condition. If you take the time to choose the management company that works best for you and your property, it can benefit everyone involved. George and Gail are real estate brokers who specialize in Lake Tahoe properties and invest for themselves around the western United States. Over the years, they have developed their own set of guidelines they have found useful in helping clients. The first thing they believe every potential investor should clarify is the stage of real estate investing they are in, as well as what they'd like to accomplish with their real estate. For example, George and Gail advise their older clients to buy property that will bring them cash flow. However, they work with younger clients differently. If they are just starting out in real estate, they have time to reap the rewards of long-term appreciation. These clients are more likely than older, more established ones to buy a place that needs lots of improvements or sweat equity. Once you've decided where you and your investment goals fit into this picture, here are some of the other pointers from George and Gail. 1. When you're considering purchasing a property, a rule of thumb is to see if the monthly rents equal 1% of the purchase price. Following this rule, a property on the market for $330,000 must be able to generate monthly rents of about $3,300 for this to be a sound investment for you. 2. Talk to everyone you know about real estate. It is always a good topic for discussion, and you can actually learn a lot and even find deals simply from talking to others. 3. If you have a choice between investing in an older established neighborhood or a brand new suburban development, choose the older neighborhood. The homes there will have more character and charm that cannot be replicated. Homes in the suburbs are a dime a dozen. 4. Buy into the best neighborhood that you can reasonably afford. 5. Even if you hear that Miami Beach is the place to invest, if you can't get there easily and regularly and you aren't familiar with the market, you will be more successful investing close to your home base. 6. Look at every potential property like you are going to resell it. What types of improvements would you have to make? If you were to purchase it, would it be economical to make these improvements in order to sell it later? 7. Also look at every property from the perspective of a tenant. Is it close to shopping and transportation? Would the type of tenants you want to rent find the property suitable for their needs? If not, could you improve it in order to attract your ideal tenant? Also keep in mind that the lower the rent, the larger the pool of potential tenants you will attract. 8. Get started in real estate investing as early as possible. 9. Hold on to a property that is appreciating. Don't sell. If you can, refinance the property and use the loan proceeds to buy your next property. 10. Be careful when considering condominium units. Don't buy if 70% or more are not owner-occupied. In these situations, there may be little pride of ownership in the area. 11. Also remember that with condominiums, you will have to pay association fees. Consider whether this money would be better spent on a larger mortgage payment. 12. Invest near colleges or universities. Although there inherently will be some damage done to the property with this group, you can be assured you won't have much trouble finding tenants. And finally, if you're trying to choose between a 2-bedroom, 1-bathroom house and one with 3 bedrooms and 2 bathrooms, choose the latter. 2-bedroom, 1-bathroom homes are always harder to sell. In addition to these guidelines that can be put to use anywhere, become knowledgeable about your city's own regulations regarding rent, such as the existence of rent control measures. When looking for a real estate broker, it can be helpful if the broker owns investment properties of his or her own. George and Gail like to share one of their personal experiences with their clients. Several years ago, they were considering buying a home in Truckee, California for $150,000. Although they knew it was a great deal, the property also needed $5,000 of plumbing work done on it. While they liked the location and the look of the property, the couple was apprehensive about paying the plumbing expense right after the purchase. So instead, they bought a house in a nearby, albeit lesser neighborhood for $125,000. Years later, their investment was a sound one. They recently sold the house for $250,000, doubling their money. However, the house they passed up soon sold as well for $550,000. From this experience, they learned to look at the bigger overall picture when investing. Had they not overanalyzed their purchase years ago, they would have made a phenomenal return even after paying for that plumbing work. Learn to respect your own judgment and intuition about a property. And be sure to use all of the real estate advantages available to you. By using the tax and legal secrets of successful real estate investors, you too can succeed in real estate investing. Good luck in all of your real estate endeavors.
This has been an Hachette Audio production of Rich Dad's Real Estate Advantages, Tax and Legal Secrets of Successful Real Estate Investors. Written by Sharon Lecter, CPA, and Garrett Sutton, Esquire. Read by Garrett Sutton. Featuring an introduction by Robert Kiyosaki and Sharon L. Lecter. Produced and directed by Dennis Kao. Text abridged by Karen D. Mattia. Rich Dad's Real Estate Advantages is also available in print from Hachette Book Group USA. Text copyright 2006 by Sharon L. Lecter and Garrett Sutton. Audio production copyright 2006 Hachette Audio. All rights reserved. Except as permitted under the U.S. Copyright Act of 1976, no part of this publication may be reproduced, distributed, or transmitted in any form or by any means, or stored in a database or retrieval system without the written permission of the publisher.